All right, welcome back everyone to another video. Today we're going to talk about turning points within a mode. So today's video is going to leverage a lot of what we looked at last video where we looked at relative equal highs and lows to be broken in order for smart money to fake out retail money, take them out of their positions and get into their own, making sure that everyone's going the wrong way and so forth, as you can remember. So what does that look like? Let's take a look. So I want to bring your attention to the space in between these two vertical lines. What do we have here? Well, looks like we have a downside price mode, correct? Right. So obviously before the downside price mode happens, we have to have an upside price mode of either the same or a lower scale to initiate it. So I'm going to go down to the 1 hour chart. So let's take a look at what happened here and what initiated this downside price mode. So here we are on the 1 hour chart. This vertical line is placed just before price starts this downside price mode. So what do we have? We have an upside price mode starting in through here, high, low, higher low. Now we have this high, and after this high, we have a lower low. So remember, if the higher high is followed by a lower low, this whole upside price mode has now been disturbed or has been changed. Um, does that mean that it's automatically going to go into a downside price mode? No. Why not? Well, think about it. If there's a ton of lows here, this could just as easily be a fake out to take price up and make everyone go short and just price to go up and continue upwards. But there's a couple reasons why it didn't do that. First of all, this highest high, look what it does. Look what it's doing. If we were to draw a line from this highest high, we're going to see that the new one breaks it, goes right above this high, this high, this high, this high, this high, this high. So what does that mean? Well, why is that important? Why are there's stops here, 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 and here? So when price comes up here, all it's doing is taking stop losses, which are buy orders, and furthermore, breakout traders going long or putting more buy orders into the market. What does that mean? It means there's lots of liquidity available for smart money to go short. So we see this, price goes above all of these relative equal highs, makes a lower low. So the combination of taking out liquidity on this side, then creating a lower low, puts us in the mood for expecting downside price mode. Now, how do we know the downside price mode is in effect? When we create a lower high instead of a higher high. So we have a higher high, and now we have a lower low, lower high, lower low, and so on. Let's see what else. Great. So now we know that price has changed modes, and then we have to ask ourselves, well, has price, how do we know where price is going to turn when it's changing modes, or sorry, when it's continuing a mode? So let's say price makes its high, and now it makes its low. Where is the lower high going to be? It's going to be above 50%. Now, I use a Fibonacci tool for this. It's not the same way other traders use it. I'm not exactly sure how they do, but this is the way I use it. When I'm looking for price mode continuation or places where I'm expecting this lower high if I'm in a downside, or I'm expecting the higher low if I'm to the upside, I'm always going to expect it to be above 50%. Why does that matter? Well, above 50% in a price leg, which is from this high, so from the high to the lower low, above 50% is a premium, which is another place where smart money wants to buy. They always want to buy in a premium. So if they're going to continue going, sorry, they want to sell here. So if they want to continue going lower, they're going to make sure to sell up in here above 50%. If obviously if we're in an upside price mode, you'd expect it to be below 50%. To continue going upwards. So we have this price leg here. Price makes a higher lower high and continues on, makes lower lows here and here. But notice how after this lower high is created and after this low is taken out, price hasn't come up here after this low is taken out. So after price creates this new lower low, this 50% level hasn't been retraced to yet. That'll be important later on because it doesn't necessarily always have to come back immediately. It can come back later. Um, and that's just something you don't necessarily have to act upon or do anything regardless. Just make sure that you know that even though price is in a certain mode and you're expecting it to turn at 50% or above 50%, maybe sometimes that lower high isn't created. And reasons for that, there's many. Maybe it wants to be visited later. Maybe it wants to engineer liquidity and get in really heavy. And so it'll create a bunch of highs below that 50% to be broken later on, just as we saw in the change of price modes. So where can we see that again? Let's take a look. So we have, now let's take a look at what breaks these lows. So remember, obviously, when we're starting upside price mode, when we're going for the low side or downside price mode, price is going to start attacking all the previous lows. So with this low, it took out all of these. The next low to be taken out is this one. Next low to be taken out is this one, then this one, then this one, this one, this one, and finally this one. So as price breaks those previous lows, what do we have? So we have price creating a new lower low and a lower high. Now let's assume this is the big move. This is the last retrace price made before breaking these lows. And so price retraced, breaks these lows, and creates a lower low down here. Where does price turn? Above 50%. And not only does it turn above 50%, but what do we have here? We have a high, a high, 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 high. Takes them all out. Gets people going short. Look at this. So you have price comes down, makes a strong move down. This holds price. This holds price again and starts going even lower. So anyone looking at this in real time would see this right here as the limit to which a price could go to. This is what's keeping price below these highs over here. So stop losses would expect it to be probably above this high here. And what does price do? Comes right above those highs, takes them out, and starts going lower. So see how this is starting to come together. So you're looking for price to come up above 50% and to take out relative equal highs before it starts turning again. So high here, 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 and here, takes them out, and we go lower. Now let's go to the next price leg. Now to the next price leg, we're going to mark from the lower high to the lower low, and we're going to expect this price turn to be above 50%. Are we taking out relative equal highs? Yes. It's not as clear here, but let me show you how. This right here is a small rally, a base, and a drop. Price comes back to it, starts turning again. So this is what would be an ideal scenario for a supply and demand trader. They see, price retrace, a rally, a base, and a drop, strong move away. Supply and demand tells these traders to place limit orders here, sell orders, place their stop right above here. So when price comes back, takes their stop loss, takes their buy order, sells to them, comes up in here and breaks these lows and continues the downside price mode. So it starts lower scale price mode and then continues down to the next one. Let's go to the next price leg. So we're marking from lower high to lower low. Where does price turn? Above 50%. Is it breaking relative highs? One here, one here. Yes, it does. Takes out some highs, goes up above 50%, and continues on. Where is the next one? From a higher high So from higher high, from lower high, the one we just made, to lower low that's just recently created. Price comes up above 50%. Where does it come up above? Relative equal highs, high, 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 high. All of these look like they might hold price and bring it down. In fact, especially this one right here, price comes up above 50%, shoots down heavily, and I can imagine a lot of people being in the market here. You know, if I was trading this and I saw this happen, I probably would have taken an order here, and would have gotten stopped out. It's okay. It happens. That's what risk management is for. You know, you're always going to get stopped out every once in a while. It's institutions are good at what they do, and so you just got to be aware of that. And if you can read price action, you can understand how price moves. And if you get faked out every once in a while, it's okay. It's part of it. Um, Ideally, your winners should be much better than your losers, and so it should be just part of the cost of doing business. You know, getting faked out is part of it. You're not going to win every single trade. No one does. Um, but last thing. So we have lower high, lower low. Price breaks 50%, comes down, breaks that last low, and it turns. So again, we see that when price changes modes, it takes out liquidity. It takes out relative equal lows in this case. So it goes to a place, it fakes something out before turning. Price would never make a big move without having taken something out, you know, just previously to doing that. Otherwise, it can't get filled. It doesn't have the liquidity. It should not be able to. And so what do we have here? Once this price mode changes, we have a boom. We have a move up. This high is now taken out. So what do we have? Now we can just do it the other way. We have high. Sorry, we have this low, the high, and now we're looking for a lower high because we're going to the upside as price has broken this, the structure has changed. So now we're looking for a lower high to be created before price continues on. Now, notice how many people would see this move down and think, okay, price is going to turn here because it just shot away. And notice how much liquidity is getting caught up in here. There's so many people seeing this move down and then a sharp move up to continue that, let's say, price mode. So let's say even we were doing it, and you were looking at this and you say, okay, price has changed modes, comes up, retraces and starts moving higher. Price is going higher than this for sure. Well, what you got to notice is that what do we remember? Remember that once price makes this move, we're expecting a retrace back in below 50% to continue moving up. And notice how nice that does that here. And not only that, but what does it take out? It takes out this low, this low, this low, this low, and that low. What were below these lows? Stop losses. These stop losses would be sell orders because people here were buying. And so the stop loss is sell order, perfect space for smart money to get in right in here. Takes all these sells, turns them into buy orders, buys from all those retail sellers, and now we can continue the price mode up. So price has now made a higher high. This higher high is taken out this next high over here. These next two highs have been taken out. So if we were looking at this in real time, now we go from the higher low, which is here, to the higher high, and we'd expect to move below 50%. See, price is now just here at 50%, or just below 50% came in, and now is shooting up. Does it mean it's going to turn here 100%? No, not at all. It could definitely come down in here. It could take some more orders. In fact, it could even come lower here if it wants to. I wouldn't expect that because we've already taken out this high, so it seems the price mode is in effect. In reality, I wouldn't really want it to go lower than this at all. If it came lower than this, then I'd be worried of the price mode. But right now, price is below 50%, and it's doing as we've expected it to do. It's going to come down into a discount and hopefully continue the price mode to the upside. So just a little background on how I use Fibonacci and other tools to start to gauge turning modes, turning points within a mode. Now, does that mean go trade it? No, remember, don't do that. This is just to help you analyze price, and as you're looking at modes, try to notice, does it come back to 50%? Does it not? Now, in events like that where it doesn't come back to 50%, there's usually a reason for it. So for instance, I know we were looking at one early on in the video, this right here. So we have a high, let me turn this around. We have a high, and we have the low taken. Notice how price hasn't really come back into this 50% area. That's important. And what that means is that sometimes it's left for the future. And what else do we notice? Well, we notice there are highs here, 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 here. You can expect more highs to be created around here. And what does that mean? Well, if there's highs here, if we remember from the last video, there's going to be stop losses above these highs. There's going to be liquidity. There's going to be tons of buy orders above these highs because a lot of people will be selling here because they see price comes down in here, doesn't even break that, shoots down. So be lots of sellers in these areas with stop losses above here, here, and here in different ways. So when price gets back here, if it were intending to go down in the long run, you'd expect it to go down in an area like this, above some highs. Here as well, there's highs here being created. Notice how these highs were just taken above by this price leg and shot sharply down. That's telling there's liquidity. There's a move here that was intentional. Money, smart money was involved there. Does it mean they're going to take it all the way lower from there? No, not at all. Maybe this was just a move to take out some liquidity to bring price lower so they could get in at a better price. There's many reasons why ITs do what they do. The idea is not really to understand why they're doing it. It's just to see their footprints and try to identify their targets they're going for. So just a little quiz right now. For an upside price mode, and let's say we're assuming that this is an absolute upside price mode, where would the next target be? Well, first target would be your highs. So here's a high. I would go for this one. There's a short-term high in here, but let's say we're expecting the upside price mode. So we'd go for this high, and then we'd see what happens. Does price come in here and shoot strongly down, or does it come up in here and stay below this lower high? Let's assume this is the lower high, and that's the higher high. Price shoots above the higher high, we'd expect it to come down and be 50%, 50% of this price leg, below 50%. And if it goes way below and starts shooting down, then you know that this was potentially a reversal right up in here, and this area was important. So that's how you start to analyze things. You use targets and see what it does at those targets to interpret what price wants to do. So again, I'm going to draw this out. It might be a little bit easier. If we have price here, and let's say it creates another high, and it goes, let's say the high is created and it goes up to this line right here. Price comes up in here and goes up to this line. Your below 50% would be here. So if price comes up in here, you'd expect the retrace to come down below 50% for it to continue going. That's the breathing room you have. If price comes up here and starts and it breaks below this, I would not maintain an upside price mode anymore. I would reassess my analysis. So hopefully you guys found this video a little bit helpful, maybe a little bit confusing. Let me know in the comments if there's something that was stuck out to you or was particularly confusing, and I'll do my best to help you out in the next videos and maybe in the comments. Till then, next time, and have a good one.